5 changes, 1 month, and every single one of them has a direct effect on the money in your pocket, whether you are employed, self-employed, a pensioner, a landlord, or simply someone with a bank account earning interest. Welcome back to HMRC Update, and today I want to do something I have not done before on this channel. I want to go through 5 specific HMRC changes that are either landing this month or reaching a critical decision point right now in August 2026, and explain for each one exactly what it means in pounds and pence, what you need to do about it, and what happens to your money if you do nothing. No theory, no background, just 5 changes, what they cost you or save you, and what action looks like. If you are not subscribed to HMRC Update, do that now before we go any further. This channel exists to turn HMRC announcements into plain English before the deadlines pass. Hit subscribe and turn on the bell. Let us get into the 5. The first change landing right now in August 2026 is one that affects approximately 1 million low-earning workers across the United Kingdom, and most of them do not know it is coming. From August 2026, HMRC will be contacting around 1 million eligible individuals directly about the Low Earners Pension Payment, previously referred to as the Low Earners Anomaly. This payment makes sure low earners achieve similar outcomes regardless of the type of workplace pension scheme they are in. Here is what this actually means in plain terms. If you earn close to or below the personal allowance of £12,570 per year, meaning you pay little or no income tax, and your employer runs a net pay pension arrangement rather than a relief at source scheme, you have been missing out on pension tax relief that higher paid colleagues receive automatically. Because you pay no income tax, the system could not return relief that was never taken. The result was a structural unfairness that HMRC has now committed to correcting.
An employee may be eligible if they did not obtain income tax relief on their pension contributions in any tax year from 2024 to 2025 onwards, specifically if they earned close to the personal allowance and contributed to a workplace pension that uses the net pay arrangement. HMRC will identify eligible individuals and contact them directly in August. You do not need to apply. You do not need to contact HMRC. You do not need to do anything at your employer's end. If you receive a letter or digital notification from HMRC about this payment in August, it is genuine. It is not a scam. It is HMRC making a correction to your pension that was owed to you. If you receive such a letter and have any doubt about its authenticity, verify it by logging into your personal tax account at gov.uk rather than clicking any links in an unsolicited email. For employees who earn near the personal allowance, this is money arriving without any action required. Check your post in August. If a letter arrives from HMRC about the low earners pension payment, read it carefully and follow the instructions if any response is needed. The second change hitting wallets this month is the one that closes permanently at midnight on the 31st of August, and that a significant number of people do not yet know applies to them. HMRC is consulting on the introduction of a criminal offense for making reckless, untrue statements or declarations in direct tax matters, with the consultation closing on the 16th of August 2026. But more immediately pressing is the separate consultation on timely payments, a reform that would fundamentally change how and when UK taxpayers pay their self-assessment tax, with the consultation closing on the 4th of August 2026. The government is exploring ways to collect more tax during the year rather than relying on large payments due each January and July. For taxpayers who have both PAYE income and self-assessment income, the proposal could require more of
their tax liability to be collected through PAYE from April 2029. Why does this matter to your wallet right now? Because if you are a sole trader, a landlord, or anyone with self-assessment income, this reform, if it proceeds as proposed, will change the timing of when your tax leaves your bank account. Instead of a large payment in January and a second in July, under the timely payments framework, your tax would be collected in smaller amounts spread throughout the year, closer to when the income is earned. For many sole traders and landlords, spreading payments throughout the year could help with budgeting and reduce the shock of large tax bills. However, it may also accelerate when tax is paid, affecting cash flow planning. The consultation is open to responses from the public. If you are self-employed or a landlord, and this reform would materially affect your cash flow planning, the window to make your position heard closes on the 4th of August 2026. Go to gov.uk and search for the Timely Payments Income Tax Self-Assessment Consultation to submit a response. After that date, the consultation closes and the government's analysis of responses begins. The third change that will affect household budgets this month involves something that has been building quietly in the background since January 2026, and that is now reaching the point where HMRC's systems are actively matching data and generating adjustments. HMRC's proposals would enable HMRC to collect debts directly from taxpayers' accounts in regular installments, supported by a comprehensive suite of safeguards to ensure the power is used fairly and proportionately. The consultation closes on the 28th of August 2026. This is the Debt Collection Consultation, a significant proposed change to how HMRC recovers outstanding tax debts that has not received the public attention it deserves. Currently, HMRC can collect outstanding tax through adjustments to your tax code, reducing your personal allowance. That more tax is taken from your wages or pension each month until the debt is cleared. What is being proposed goes further. Under the consultation proposals, HMRC would have the power to recover debts directly from bank accounts through direct debit-style installments without requiring the taxpayer to set up a time-to-pay arrangement first. The safeguards proposed include minimum balance protections, HMRC could not leave an account below a specified threshold, and a right to challenge the collection before it begins. But the direction of travel is clear. If you have outstanding tax debts from an underpaid self-assessment bill, an overpaid tax credit being recovered, a PAYE underpayment from a previous year, the mechanism through which HMRC recovers those debts is heading toward becoming more direct, more automatic, and less dependent on the taxpayer initiating a repayment arrangement. The practical action for anyone with an outstanding HMRC debt right now is to address it before the regulatory environment around debt collection becomes more powerful. Call HMRC on 0300 200 3822 and set up a time-to-pay arrangement on your terms, based on what you can realistically afford. A voluntary arrangement you negotiate gives you more control over timing and amounts than an automated collection HMRC initiates. The consultation closes on the 28th of August. The policy that follows from it is expected to form part of future legislation. Drop a comment below if you have an outstanding HMRC debt and had no idea this consultation was happening. The number of people with unresolved tax debt who are unaware that the collection mechanisms are about to become significantly more robust is very large. Back to the other two changes. The fourth change affecting your money this month sits at the intersection of where you bank and what HMRC already knows about it, and it connects directly to a savings position that hundreds of thousands of UK taxpayers have not yet reviewed since interest rates changed. The personal savings allowance has been frozen at £1,000 for basic rate taxpayers and £500 for higher rate taxpayers since 2016. Meanwhile, the Bank of England base rate has moved significantly upward and then begun to ease, but savings rates across banks and building societies remain at levels that for anyone with meaningful savings outside an ISA are generating interest well above the tax-free allowance. HMRC receives annual reports from banks covering savings interest paid to UK account holders. Those reports arrive after each tax year ends and feed directly into HMRC's simple assessment process. For the 2025 to 2026 tax year, which ended on the 5th of April 2026, those bank reports are now inside HMRC systems. The simple assessment letters being generated from that data are landing on doorsteps right now in August 2026. If your savings outside an ISA earned more than £1,000 in the 2025 to 2026 tax year, which at current savings rates means a balance above roughly £20,000 to £25,000 depending on the account, a simple assessment letter may be on its way or may already have arrived. The letter is a formal HMRC tax demand. The payment deadline is either the 31st of January 2027 or 3 months from the date of the letter, whichever is stated on your specific document. The action this month is to check your savings interest for 2025 to 2026 against your personal savings allowance. Review your bank statements or your annual interest summary if your bank provides one. If your interest exceeded £1,000 as a basic rate taxpayer or £500 as a higher rate taxpayer, expect a letter. If a letter has already arrived, read the figures carefully, compare them to your own records, and if anything looks wrong, an ISA amount included an error, a joint account not split correctly, call HMRC on 0300 200 3310 within 60 days of the letter date to challenge it. If the figures are correct, pay by the deadline shown or contact HMRC to discuss.
Payment options. Moving savings from non-ISA accounts into a cash ISA before the end of the current tax year is the most straightforward way to remove this liability going forward. The annual ISA allowance for 2026 to 2027 is £20,000. Interest earned inside an ISA is not reported to HMRC and does not count toward the personal savings allowance. For anyone who has been watching their non-ISA savings interest accumulate without considering the tax position, August is the moment to act on it. The fifth change affecting your wallet this month is the one that has the most direct and immediate financial consequence for the largest number of people, and it is the one I want to make sure you leave this video understanding completely. HMRC is reviewing its benchmark scale rates and overseas scale rates, the flat rate allowances businesses can use to reimburse employees for meals, accommodation, and travel expenses without checking every receipt. The government says the review will consider whether current rates still reflect actual costs and whether the system can be simplified. For self-employed people and employees who claim business expenses, this matters because the benchmark scale rates are the approved flat rate figures that HMRC accepts without requiring receipted proof for each individual claim. If those rates change as a result of the review, either upward to reflect current costs or restructured to change the categories, the amount you can claim tax-free for business travel, subsistence, and accommodation will change accordingly. But the more immediate wallet impact of the scale rates review is what it signals about HMRC's enforcement posture toward expense claims in the second half of 2026. The review is explicitly asking whether current rates reflect actual costs, which means HMRC is aware that in some cases, the rates being claimed may be above what is genuinely being spent. When HMRC reviews a relief system, enforcement activity around that relief
typically increases in parallel with the review, as the department builds its understanding of how the rules are being applied in practice. If you claim business expenses, whether through self-assessment as a self-employed person or through a P87 form as an employee, August is a sensible moment to review whether your claims are correctly calculated, properly evidenced, and reflect genuine business costs rather than estimates. The risk of an inquiry into expense claims is not high for any individual taxpayer, but it is higher during a period when HMRC is actively reviewing the framework that governs those claims. A clean, well-documented expense record is the most straightforward protection against that risk. So here is where all 5 changes sit and what they mean for your wallet this month. If you earn near the personal allowance and contribute to a net pay workplace pension, watch for a letter from HMRC in August about the low earner's pension payment. It is genuine and it is money owed to you. If you are self-employed or a landlord, the timely payments consultation closes on the 4th of August 2026. If you want your voice heard on how and when your tax is collected going forward, respond before that date at gov.uk. If you have an outstanding tax debt with HMRC, the debt collection consultation, which could give HMRC new powers to collect directly from your bank account, closes on the 28th of August. Address outstanding debts now by calling 0300 200 3822 and agreeing a time-to-pay arrangement on your terms while the current framework still applies. If your non-ISA savings earned more than £1,000 in interest during 2025 to 2026, a simple assessment letter may already be on its way. Check your savings interest figures now and review the letter carefully when it arrives. Challenge any errors within 60 days by calling 0300 200 3310. And if you claim business expenses, review your records now against the current benchmark scale rates and ensure your claims
are evidenced. HMRC's review of those rates signals increased attention on expense claims in the months ahead. 5 changes, 5 wallet impacts, 5 things to act on this month rather than after the deadline or the letter has already arrived. HMRC's main priorities during the year are reducing the tax gap, improving customer experience, and modernizing the tax and customs system. That means more data, more automation, more letters, and less time between the point HMRC identifies a discrepancy and the point they act on it. The people who act first are the ones who stay in control of that process. Share this with someone whose wallet is affected by any of these 5 changes and who has not been following HMRC's updates this month. Subscribe to HMRC Update if you are not already here.